Okay, let's unpack this. You open your investment app, you see a chart that looks like a roller coaster designed by an absolute maniac, and you think to yourself, I can predict this?
Right.
I know exactly where this line is going next.
But do you really?
Exactly. Or are you just taking a random walk?
That is the big question. And if you ask Burton Malkiel, the author of the book we're diving into today, A Random Walk Down Wall Street, the answer is a pretty definitive no. You generally do not know where it's going.
Which is a tough pill to swallow for a lot of people.
Oh, absolutely. But here is the really fascinating twist. While the math says the market is a random walk, meaning short-term moves are basically unpredictable, the psychology behind why we buy and sell isn't random at all.
It's predictably irrational.
Exactly.
And that is why I am so excited about this deep dive today. We aren't just talking about index funds or asset allocation. We are going on a grand tour of human folly.
That's my favorite kind of tour.
Right. We are looking at the history of financial mania to figure out why smart people do incredibly stupid things with their money.
And to understand that, it really comes down to a battle between two philosophies that Malkiel lays out in the book. On one side, you have the firm foundation theory.
Okay, the firm foundation.
Yeah, this is the logical side. It says every asset, whether that's a stock, a house, or even a flower bulb, has an intrinsic value, a firm foundation based on what it can actually earn in the future.
That makes total sense.
Yeah.
You buy something because it's objectively worth something. But then you have the other side,
The fun side.
the one that makes for much better stories, yeah.
The castle in the air theory. This is the purely psychological side. It doesn't care about intrinsic value at all. It says an investment is worth a certain price simply because you believe someone else will buy it from you for even more later on.
The greater fool.
The greater fool theory, exactly. You're building castles in the air. It's about mass delusion.
Building castles in the air. I mean, it sounds poetic until gravity kicks in.
And it always does.
So let's go back.
Yeah.
Way back. We're starting our tour in the 1600s
Mm.
in Holland. And I always think of the Dutch as very sensible, pragmatic people.
They are. Very grounded. But in the 17th century, they just lost their collective minds over tulips.
Tulip mania.
The granddaddy of all bubbles. It started innocently enough. A botany professor brought some bulbs over from Turkey. But then a virus hit the tulips. It was called mosaic.
Wait, a virus? People were paying top dollar for sick plants.
Ironically, yes. The virus didn't kill the plants, but it caused these bizarre flame-like stripes on the petals. They called them bazaars. Suddenly, these infected bulbs became the ultimate status symbol among the wealthy.
So it's kind of like the 17th century equivalent of a limited edition sneaker drop.
That is a perfect way to put it. And when status is involved, the money follows. Malkiel describes this frenzy where people weren't just using spare cash. They were trading land. They were trading jewels, furniture.
Flowers.
Entire estates were swapped for a single bulb.
But how did regular people even afford this? If a bulb costs as much as a house, you run out of buyers pretty fast, right?
And that is where the financial innovation comes in. This era popularized what we now call call options.
Ah, okay. Leverage.
Exactly. Think of it like gambling with leverage. You didn't need the full price of the bulb. You just paid a small premium, a fee, for the right to buy the bulb later at a set price.
So it turned the flower market into a casino. You could bet a fortune for the price of a beer.
It allowed people with very little money to participate in the mania, which just drove prices up to astronomical levels. But I have to say, my favorite story from this time isn't about the finance at all. It's about a sailor and an onion.
I don't know this one. What happened?
It is a tragedy of errors. So a sailor brings news of a shipment to a wealthy merchant. The merchant is thrilled, feeling generous, so he gives the sailor a fine red herring for breakfast.
Nice guy.
Right. Well, the sailor sees what he thinks is an onion sitting on the counter and thinks, this would go great with my fish.
Oh no, please tell me he didn't eat it.
He peeled it and he ate it, but it wasn't an onion.
It was a tulip.
It was a Semper Augustus tulip bulb, one of the rarest.
He literally ate the investment.
He ate a bulb worth enough to feed his entire ship's crew for a full year. He just chomped on it as a garnish for his herring.
That is physically painful to hear. I'm guessing it didn't end well for him.
He ended up in prison for a felony, naturally.
Well, naturally. But eventually the music had to stop for everyone, right?
It always does. Prices got so high that some of the smarter people decided to cash out. And once the selling started, everyone wanted to cash out. total panic.
The castle in the air just evaporated.
Completely. The government even tried to step in. They tried to settle contracts at just 10% of their value, but prices fell even below that. Bulbs that were worth literal estates became worth, well, about as much as a common onion.
So that's the Dutch. Let's jump forward a century to England. The 1700s. The South Sea bubble. Now, this feels a bit more like a modern corporate scandal than a flower craze.
It does. It started with the South Sea Company. They took on a massive amount of British government debt in exchange for a monopoly on trade in the South Seas.
Which sounds great on paper.
Except for one problem. They had absolutely no expertise in trade. None.
Minor detail.
But they had hype. The directors were absolute masters of the castle in the air theory. They were bribing everyone in Parliament to pump the stock. They even bribed the king's mistress.
Really?
Oh, yeah. And her nieces, who reportedly looked suspiciously like the king, they got free stock just to talk up the company at parties.
Okay, but the South Sea Company was just the main attraction. I was reading in the book that it spawned all these absurd copycat bubble companies.
The bubble companies, they are hilarious. They were real companies floating on the stock exchange. There was one company formed specifically for extracting sunlight from cucumbers.
I'm sorry, what? Why would you?
To save it for the window.
Hey, never mind. That's just...
Another one was for importing jackasses from Spain. Despite, as Malkiel dryly notes in the book, there being plenty of jackasses already in England.
That is a sick burn from the 1700s. I love it.
And then there was the Puckle Machine Company.
The buckle machine. Okay, what did that do?
It was a machine gun.
In the 1700s.
Yes, but the key feature was that it was designed to fire round bullets for Christians and square bullets for Turks.
Wait, square bullets. Because the shape makes it, what, more painful?
The logic literally was that square bullets would inflict more damaging wounds on the infidels. It was total, utter nonsense. But people bought the stock.
You just wanted in on the action.
Exactly. But the winner, the absolute peak of this whole mania, was a company with a prospectus that read, and I quote, "For carrying on an undertaking of great advantage, but nobody to know what it is."
Stop it. People actually invested in a secret.
They did. The promoter opened the subscription books at 9 a.m., took in an absolute fortune, and by 2 p.m. he was on a boat to the continent, never to be seen again.
That is incredible. But surely the really smart people, the intellectuals of the day, they saw through this and stayed away, right?
You would think so. But Isaac Newton, the man who discovered gravity, one of the smartest humans to ever live, lost a massive fortune in the South Sea bubble.
Even Newton got played.
He got caught up in the crowd. He famously said afterward, "I can calculate the motions of heavenly bodies, but not the madness of people."
Wow. So if the man who invented calculus couldn't spot a bubble, what chance did the average person have, especially when the game was rigged? Which brings us to America in the 1920s, the Roaring '20s.
No, this was a different beast entirely. In Newton's time, it was mass hysteria. In the 1920s, it was coordinated mass manipulation. This is where Malkiel explains the concept of investment pools.
Yeah, let's talk about the culture first, though. Business was practically a religion back then.
Oh, literally. Bruce Barton wrote a bestseller claiming Jesus was the first businessman. That was the atmosphere. Business could do no wrong.
So how did these investment pools actually work? Was it legal?
It was perfectly legal at the time. It's highly illegal now. But back then, a group of wealthy managers would band together to manipulate a specific stock, like RCA, for example.
Radio Corporation of America. High tech for the 20s?
Exactly. So the pool managers would trade the stock back and forth among themselves.
So they're just selling the same shares to each other?
Yes. It's called wash sales. They buy and sell to each other rapidly to create the illusion of huge trading volume.
Ah, I see.
Right. So the public watches the ticker tape. They see RCA stock moving like crazy, and they think, something big is happening with RCA. I need to get in before I miss out.
So the pool managers lure the crowd in with fake activity.
Precisely. And once the public buys in, which drives the actual price up for real, the pool managers pull the plug. They dump all their stock on the unsuspecting public at the top and walk away with massive profits.
That is brutal. It's a rigged casino. And yet, people fully believed it would just go on forever.
They really did. You had someone like Roger Babson. They called him the Sage of Wellesley. He predicted the crash. But nobody listened to him. They listened to Irving Fisher.
A brilliant economist.
Brilliant, yes. But he made the infamous statement just days before the 1929 crash. He said, stock prices have reached what looks like a permanently high plateau.
A permanently high plateau. That might literally be the worst prediction in financial history.
It's definitely up there. But it shows that even the most credentialed experts will construct elaborate intellectual justifications for why this time is different.
Okay, let's fast forward to the 1960s, the soaring 60s. The psychology remains exactly the same, but the method changes again. This time, it wasn't about manipulative pools. It was about what Malkiel calls the name game.
The Tronics boom. This is hilarious. If you wanted your stock to double in the 60s, you just needed a space age name.
Just change the letterhead.
Basically, Malkiel compares it to a company selling shoelaces. If your name is Shoelaces, Inc., you trade at maybe 6 times your earnings. Boring. But if you change your name to Electronics and Silicon Firth Burners?
Wait, what is a Firth burner?
Nobody knows. That's the entire point. It sounds like the future. So suddenly you're trading at 40 times earnings just because you sound high-tech.
Pure castle in the air. But the 60s also gave us the conglomerate boom. Now, this is the part of the source material I actually struggled with a bit. Malkiel talks about synergy and how companies used math tricks to look like they were growing rapidly. Can you break that down? How do you fake growth with math?
It is the ultimate castle-in-the-air accounting trick. Synergism. The idea that 2 + 2 = 5.
Right.
Let's make this concrete. Imagine you have a high-flying, popular company, let's call it Able Circuit Smasher.
Got it. Able.
And its stock is very expensive. It trades at, say, 20 times its earnings. It's got a high PE ratio.
Okay, Able is the cool kid on Wall Street.
Right. Now, Able buys a really boring company. Let's call it Baker Candy. And Baker only trades at 10 times earnings.
Cheap.
Very cheap. So Able uses its own expensive stock to pay for the cheap Baker Candy Company.
So they swap shares. They don't use cash.
Yes, a stock swap. Because Able's stock is so valuable, they don't have to give away very many new shares to buy Baker entirely.
Like that's with you.
But, and here is the magic trick, once they buy them, Able gets to add all of Baker's candy earnings to their own books.
Oh, I see. So their total earnings go way up. But the number of outstanding shares didn't go up by nearly as much.
Bingo! So the earnings per share jump significantly. On paper, it looks like Able is growing incredibly fast.
But they didn't actually sell more circuits. They didn't make the candy business better.
Not at all. They just bought earnings using inflated stock.
It's a complete illusion.
It is. But Wall Street absolutely loved it. Companies like Automatic Sprinkler, which later became Figgy International, they use this exact trick to go on massive buying sprees.
And people bought the story.
They bought the dazzle speak. Automatic Sprinkler's CEO even invented fancy terms like the nucleus theory of growth to dazzle the investors.
The nucleus theory of growth, it sounds very scientific.
Pure jargon. Eventually, the math stops working because you literally run out of cheap companies to buy and the whole house of cards collapses.
Which brings us to the 1980s, the decade of excess, and the return of the concept stock.
Oh, the 80s. This is where the story gets really bizarre again. There was a company called Fine Art Acquisitions.
Okay, sounds classy.
You'd think. They didn't have a factory. They didn't have a tech product. Their main asset was a portfolio of nude photos of a prepubescent Brooke Shields.
Wait, that was the company. That was the core investment.
That was the concept, and the market speculated heavily on it. And then you had the biotech bubble, where companies with zero earnings were valued billions based purely on a theoretical product pipeline.
Just hoping for a miracle drug. But if you want a story about pure deception from the 80s, we have to talk about ZZZZ Best.
Oh, yes. The aha story of the decade. Barry Minko.
Right, the teenage genius with the carpet cleaning business.
That's the one. He started it in his parents' garage. He was a sensation. He was on Oprah. He was the literal boy wonder of Wall Street. And the stock went through the roof.
But it wasn't just carpets, was it?
Not even close. It was a massive Ponzi scheme. The carpet cleaning business was largely a front. He was actually laundering money for the mob. He spent millions faking massive restoration contracts for buildings that literally didn't exist to fool the auditors.
A mob front listed on the NASDAQ.
Yeah.
You really can't make this stuff up. But here's the part that blew my mind when reading Malkiel's account. It's what happened to Minkow after he got caught.
It is an unbelievable character arc.
Right.
So he gets caught, he goes to prison, he gets out, becomes a Christian pastor, and completely reinvents himself as a fraud buster.
Right. He uses his insider knowledge for good.
Exactly. He works at the FBI to uncover corporate financial crimes.
An amazing redemption arc.
You would hope so.
Hmm.
But leopards rarely change their spots. He ended up going back to prison.
What for this time?
stealing millions of dollars from his own church.
Unbelievable. It just shows that the psychology of the thrill of the castle in the air is so hard to break. Now, we can't talk about the 80s without mentioning Japan.
The Japanese asset bubble. The scale of this was genuinely terrifying. To give you an idea of the mania inside Tokyo, you have the Imperial Palace.
Right, the big plot of land right in the middle of the city.
At the height of the bubble in 1990, the ground under the Imperial Palace in Tokyo was estimated to be worth more than the entire state of California.
Hold on, let me process that.
Yeah.
One palace grounds versus the entire Golden State. Silicon Valley, Hollywood, the Central Valley farmland, the entire coastline, everything.
Everything. It defied all known logic. But it wasn't just land. Golf club memberships were trading like highly liquid stocks. A membership to a prestigious club could cost millions and millions of dollars.
That's insane.
Corporate Japan was spending so much on entertainment and lavish business dinners that it accounted for something like 1% of the entire country's gross national product.
That sounds like a party that was doomed to end with a massive, massive hangover.
And it did. The crash was devastating, and the economic stagnation lasted for decades. But of course, Americans looked at Japan in the 90s and said, well, that's them. We're smarter than that.
Enter the dot-com bubble.
Exactly. The sequel to the Tronics boom. Just add .com to your name. Researchers actually found that companies that changed their name to include internet saw their stock jump instantly, even if their business had literally nothing to do with the web.
It's shoelaces.com. But there's one specific example from this era that I need you to explain slowly, because my brain refuses to accept the math on this one. The 3Com and Palm split.
Yes. This is my absolute favorite example of pure market inefficiency. So 3Com was a big, established, profitable tech company, and they owned a subsidiary called Palm, the people who made the Palm Pilot.
I loved my Palm Pilot. The little stylus was very satisfying.
It was great tech. So 3Com decides to spin off Palm into its own separate public company. When Palm went public, the tech mania was so intense that the total value of all Palm shares became higher than the total value of 3Com.
Wait, but 3Com still owned the vast majority of the Palm shares even after the spinoff.
Exactly. So do the math. If Palm is worth, say, $50 billion and 3Com owns most of Palm, 3Com should logically be worth at least $50 billion.
Right. Plus whatever 3Com's other legacy businesses were worth.
Right. But the market valued 3Com at less than Palm. This implied that 3Com's other highly profitable businesses, their routers, their modems, everything else, were worth negative $25 billion.
A negative $25 billion company.
It means that if you bought 3Com stock, the market was effectively paying you billions of dollars to take their non-Palm businesses for free. It was a mathematical impossibility.
But people kept buying Palm anyway.
Because nobody was doing the math. They were building castles in the air, they were buying the momentum, the hype. They were completely ignoring the firm foundation.
So we've walked through tulips, square bullets for infidels, fake carpet cleaning, and negative billion-dollar tech companies. We just keep doing this over and over. Why?
I think if we synthesize all these stories, the core lesson is what Malkiel calls the greater fool theory. In every single one of these bubbles, deep down, many of the participants actually know the prices are crazy.
They know it's a castle in the air. They aren't totally blind.
They do, but they buy in anyway because they believe they are smart enough or fast enough to get out before the crash. They believe there's a greater fool out there who will pay even more tomorrow.
But the problem is, eventually you run out of fools.
You always do. As the old Wall Street saying goes, trees don't grow to the sky. Whether it's a flower bulb in the 1600s or an internet stock in 1999, the laws of financial gravity eventually take hold. You cannot defy the firm foundation forever.
It is a really sobering thought. I mean, we like to think we're sophisticated, rational, modern investors, but our brains are wired exactly the same way as those Dutch sailors.
We crave the story. We crave the easy win. And that fundamental human desire makes us permanently vulnerable to the next mania.
So here is a final thought for everyone listening. We're living in an era right now of cryptocurrencies, NFTs, explosive AI valuations. Malkiel even mentions briefly in the book that Bitcoin promoters are following the long tradition of John Law, who famously tried to replace metal money with paper in France in the 1700s, which ended in disaster.
That is the defining quadrant of our current market.
Are we building the firm foundations of the future economy right now with this new tech? Or are we just constructing the newest, most high-tech castles in the air?
That is something every single listener needs to honestly answer for their own portfolio.
Indeed. Thanks for taking this random walk with us. We will see you on the next deep dive.